Today we take a closer look at India. The Prime Minister of India made a surprising tax cut a couple weeks ago. The stock market rallied up over 5% in a day. In our studio we have our portfolio manager Abhishek. Welcome, Abhishek.
Thank you so much for having me.
Can you give a short brief of what happened in the Indian stock market these past weeks?
Perfect. If you look at the Indian markets over the past 6 to 9 months, they have remained very, very volatile. One of the reasons has been that India has done a lot of reforms, and some of the reforms have been disruptive. And as a result, we have seen some slowdown of growth in India, which was a kind of disappointment, and the markets have moved sideways since then. But however, this big announcement of tax cuts by the government was a big surprise. It's a reform in the right direction. It's a very pro-growth reform from the medium-term perspective. And markets seem to like that, and that is why we have seen the kind of reaction which was not expected. So we are very positive on the markets from going forward on the 6 to 12 month basis, and even beyond that. We feel that this is a very pro-growth reform, and if implemented in the correct way, it can take back growth towards the 7 to 8% levels again.
It was a big cut. Why?
It was a big cut indeed. If you look at the tax cuts, if you look at the previous corporate tax rates, which were almost close to 35%, they were very, very uncompetitive. If you put in perspective compared to that of China and some of the Southeast Asian countries like even Thailand, Malaysia and Vietnam, where the tax rates were much, much lower. As a result, India lost out when it came to the world setting up the manufacturing factories, which all went to these areas. So that was one of the reasons to attract more foreign investments into India, and also to kickstart a capex cycle in India, which have been missing for the past few years. The government decided to take this reform. The government has also been very, very vocal about supporting the initiative they have been talking about, that is Make in India. So this bodes very, very well for them, because the new tax rates, which is like almost 25% now, is almost in line with that of China, or at par with China and other Southeast Asian countries. And another big announcement was that if you set up your manufacturing plants, say like beginning from October of 2019, and if you start producing from those manufacturing plants before 2023, then you have to pay only 15% tax. Now that is a game changer, because as everyone is aware that China and US are having a lot of trade disputes, and there is a possibility that a lot of companies will want to diversify their supply chains out of China. So India can gain in a big way with this new tax structure. It can attract a lot of foreign companies to come up and set up their manufacturing plants, and also it encourages domestic companies to increase their capex plans, which they have not been doing in the past many years, which also led down to some kind of slowdown.
And this was surprising to the market. Was it surprising to you as a portfolio manager that there was this big cut?
Yeah, it was kind of a surprise. Although the government has been talking about rationalizing the corporate tax structure over the past many years, they have shown the intention. But it was a surprise given the fiscal condition of India. The fiscal deficit is still running high, although it has come down quite a bit from the 2014 levels. But we thought that doing something like this will take a big fiscal impact on the country. So we're not expecting. But the good part is that the government has announced this tax cut, and they have also done some homework when it comes to managing the fiscal, because it's going to be almost $20 billion of shortfall of government revenues by giving away these tax cuts. They have announced to do privatization of a lot of public sector entities, and through that they can raise a lot of money and plug this fiscal deficit gap as well. So this was a surprise. It was the noise was there for almost last 3 to 4 years, but it came as a surprise. You know that this government has been surprising when they announced demonetization, GST reforms, and this reforms. It's always been big bang, and it has always come at the time when you did not expected it to come.
Yeah. What do you say the impact in the Indian economy in the short and long term?
In the short term, I feel the impact may not be that visible. It might take at least 6 to 12 months before the companies digest this in the news flow, the new tax structures. From the medium term perspective, we remain very positive, because this should definitely lead to some kind of growth in the capex cycle, which has been missing, as I previously said. This should be one of the good impact. The second impact actually will come, say like in the short term, will be earnings upgrades. Because you know that a lot of companies in India paid almost 35% tax rates, and now they have to pay 25%. So straight away they will gain 10% on the earnings. So which is positive from the short-term perspective. But from the long-term perspective, I think it's very, very positive for the growth to become more sustainable. Because last few years we have seen growth of India only driven by consumption, which is a good growth. But if it's not backed by reforms and not backed by supply side reforms, it is not sustainable. But doing this, it will take the growth back towards 8% growth, which should be sustainable for, say, like many years to come.
Yeah. After the tax cut, have you done any changes in the fund?
We have always been very focused about the Indian domestics. So we have been overweight Indian financials, especially the large corporate banks. The reason being that they have cleaning up their books for the long time. The asset quality has been improving. They have been they have started to gain a lot of market share from the PSU banks, which are struggling for capital. And we are and also starting to get market share from the non-banking financial companies, which are in stress right now. So we have been overweight that. These guys used to pay almost 35% tax rate, and now they have to pay 25%. So that is straight away a big benefit for them. They have gained a lot in this because as I said, if the capex cycle comes back, then the lending will also improve for them to the corporates, which will lead to higher margins. So we have been very positive with them. And we have been focused on the domestic consumption theory for India because, you know, if you look at the last 10 years, we have seen some decent rise in the income levels. And India is still a low middle income country, and we should continue to see that income growth to happen over the next decade as well. So we have always been geared towards consumption stocks, which rallied a lot again in this kind of scenario. They are very, very growth oriented stocks, and with the growth coming back, we feel that they should do well over the next 12 to 24 months.
Abhishek, thank you.
Thank you so much for having me.
And thank you for watching this broadcast at DNB.